Welcome, everyone. Welcome. Thank you for joining. It's going to be an awesome session today. If you are new to joining me, we upload lectures here all the time, and we are talking about advanced audit today. So if you haven't subscribed to the channel, the YouTube channel, please do so. Please do so. We post a lot of lectures here. I don't want you to miss out. It will help you to pass your exam with ease. So you just need to subscribe and hit the notification bell so that anytime I post a video, you'll be notified and you receive a notification for it. Then these are our social media handles. On Facebook, you can look for us, Pinnacle Professional College. On our Instagram, you can find Pinnacle Professional College as well. Okay, so let's start with today's objectives. Let's dive right into it. Today, we'll be talking about the fundamental principles. We'll be talking about independence, and we'll be talking about confidentiality and conflict of interest. So let's start. Let's start with fundamental principles. So the professional bodies that regulate the audit profession usually will set, some high standards for their members. That is people who are students, either students or people who have passed the exam and are working, and their code or their standards apply to all members, So usually professional bodies will have a high standards, to which they task their members, The ICA Ghana has adopted the IS barcode, the IS barcode. That's what the ICA has adopted, and that's what we'll be basing our fundamental principles on. So that's very, very important. The IS barcode has been undergoing modification and revisions, but I would want to talk more about the fundamental principles of the IS barcode, which are, let's talk about that. So I use an acronym for it, which is COPPI, C-O-P-P-I, COPPI, C-O-P-P-I. So it starts with, first thing is confidentiality. A professional accountant or auditor must always be confidential with client information. The client has given him or her very, very sensitive information that is necessary to be guarded. You shouldn't leak out that information. So that's very, very key. That's very, very important. You can only disclose such information when there's like a professional right or duty to disclose, or there's a legal restriction, or there's a legal enforcement that makes you, forces you to disclose such information. So that's very, very important. Then we said COPPI, C-O-P-P-I. So what's O? O would be objectivity. A professional accountant shall not compromise professional or business judgment because of bias. So the professional accountant shouldn't be biased, shouldn't, be influenced badly to sway their decision in favor of, or to sway their decision in favor of somebody else when it's not supposed to be them. So they must always be objective. They must be unbiased in their dealings as a professional accountant. Very, very important. Then the P, so C-O-P-P-I. So the first P is professional competence and due care. A professional accountant has a continuing duty to attain and maintain professional knowledge. He must keep his skills abreast with the times, He must ensure that he's well updated, he's technically skilled, he's competent at his work. It's very, very important. The ISBA code regards that as a fundamental principle. You have professional behavior. A professional accountant shall also comply with relevant laws and regulations. The professional accountant must comply with relevant laws and regulations, and also he shouldn't do anything that will bring discredit to the profession, that would dent the image of the profession. So that's professional behavior. The professional accountant must apply with all laws and regulations and shouldn't do anything that would discredit, the profession. Then the I means integrity, which means honesty. Honesty. The professional accountant or the auditor must be honest in their dealings. Very, very key. Very, very key. Then you have independence. You have independence. Independence. So let's talk about independence, which is a critical concept when it comes to audits. What we said that our auditors are supposed to give their opinion on the financial statements, but they cannot do this if they are not independent. They have to be independent from any influences. So when we talk about independence is in twofold. First, you have independence of mind and independence in appearance. Independence of mind and independence in appearance. So what does it mean? What does it mean? So independence of mind refers to a state of mind. A state of mind, where the auditor is able to express a conclusion or an opinion on a financial statement without being affected by influences that will compromise his or her professional judgment. It's in their mind. In their mind, they are being independent. So they will not allow anything to influence them to compromise their professional judgments. Very, very important. So in this case, the auditor himself or herself is independent. Now let's look at independence of appearance. Independence of appearance is basically how informed third parties see the auditor. Independence of mind is the auditor himself being independent. Independence of appearance is how others see the auditor, how informed third parties see the auditor. So independence of appearance means the avoidance of facts and circumstances that are so significant that an informed third party would conclude that the auditor's integrity has been compromised. So if there are any facts or circumstances surrounding the auditor, that makes it seem that the auditor's professional judgment is compromised. That affects independence of appearance. So for example, if an auditor owns shares in a client, he or she audits, that's a problem. That's a problem right there, because in that case, will you be independent enough? Because you have a financial interest in the firm. So auditors always need to be fully aware when it comes to situations that damage their independence and objectivity. So those situations is what we call threats to auditors' independence. Then because they are threats, these threats can also be reduced by safeguards. There are safeguards that you use to ensure that auditors are able to mitigate the effects of these threats. Very, very key. Very, very key. Okay, so let's talk about something very crucial, the threats to independence. So the threats to independence, we have the self-interest and the self-review threats. So the self-interest threats arises when the accountant or the audit firm has a financial interest or another kind of interest in the organization. So for example, like what we said, if you own shares, then that's a financial interest, and it raises a self-interest threat. Very, very important. Very, very important. Then you also have the advocacy threats. So let's talk about self-review threats first before we move on to advocacy. It's getting exciting. So let's move on to self-review threats. So when we talk about self-review threats, it simply means that this is where the accountant or the auditor is required to review or reevaluate a previous judgment that is made by them. So they are reviewing their own work. It's basically someone telling you that, take this exam and mark it yourself. That's a threat. That's a threat right there. So you can't take an exam and mark it yourself. That's not possible. You also have advocacy threats. Advocacy threats. This occurs when an accountant is in a position where he's expected to justify or defend the client or act as an advocate for the client. So a typical example would be defending the client in judicial matters in the court. It's a threat to independence. An auditor is not supposed to be defending the client. If he's defending the client, it becomes an advocate and it's a threat to independence. Just think about it this way. If an auditor prepared a financial statement of a client and, perchance the court, calls them, to come explain, some illegality around it, since the auditor prepared the financial statement, he would say, you defend the clients. And so in that case, they are not independent. You have intimidation threats. Intimidation threat is where the client basically threatens to withdraw their business from the auditor. So they threaten them and say, we'll take away, our business from you. So you won't get your audit fees, So a typical example is the client may threaten that it will take work away from the firm unless it agrees with management's point of view. That's a dangerous threat. That's a dangerous threat. Then you also have the familiarity threat. So on the familiarity threat, this occurs when, the auditor has had a long association with the clients, such that they become very close and, it's become more of an emotional relationship, and so in that case, your independence might be threatened in that regard as an auditor. So it makes the auditor a lot more sympathetic towards the client's position due to the length of relationship that they've had. So let's talk about the guidance on threats that accountants face. Here we'll be talking about safeguards and all that. There are a lot of them, and so we'll try to go through them step by step. So we talk about a financial interest, right? A financial interest constitutes is a threat, and it constitutes a self-interest threat, because when an auditor has a financial interest in an organization, it's not independent. It's not independent. So there are certain things that you need to look at. You need to look at the role of the individual holding the interest, the materiality, how significant the interest is, and the degree of control the accountant has. So what does the guidance say? The guidance says that if a member, an auditor, or their immediate family member holds a direct interest, holds a direct interest in an organization, it should be disposed of. It should be disposed of, or the member or the auditor should be removed from the engagement so that it's independence, so that you'll be independent, you will be independent to work on other clients, not on the clients which he has financial interest in. Because once you have financial interest in, your hands are tied and you are not independent. So it says the guidance recommends that a member of the assurance team or an immediate family member of that team shall not hold a direct financial interest or an indirect material interest in a client. The interest should either be disposed of or the team member removed from the engagement. So another situation where a threat could arise is loans and guarantees, still the same financial stuff, right? A loan from a client, which is a bank or similar institution that is made on ordinary or commercial terms, does not constitute a threat to independence. However, loans or guarantees made by assurance clients in other circumstances that are not necessarily normal commercial terms or normal commercial transactions constitute a self-interest threat and should be avoided. So what's the caveat here? The loan or the guarantee must be what? Within normal commercial terms. Normal commercial terms. Very important. Then let's talk about more on the guidance on threats accountants face. Let's talk about a situation like close business relationships. Close business relationships. So when you have close business relationship with assurance clients, it can create even an intimidation threat. It can create familiarity threats. And sometimes it can even create a self-interest threat, so close business relationships must be watched. That's why a lot of regulations say that audit firms should be moved periodically around clients. So you shouldn't stay with one client for 50 years, 100 years. No, you should be moved from one client to another so that you don't form long associations that would affect your independence. And you have family and personal relationships. So for family and personal relationships between assurance staff and clients, family and personal relationships between assurance staff and clients might cause familiarity threats, self-interest threats. All those things might come in. All those things might come in. So what kind of family and personal relationship that will cause these threats? We need to know. So when an immediate family member of an auditor, right? If an auditor has an immediate family member who is a director, officer, or employee in the client you are auditing, who has significant influence. So when we talk about significant influence, he's able to take strategic decisions. Then it's a threat to independence. The threat is great, and most likely it can be resolved by removing this individual from the engagement team. Let me repeat that again. If an auditor has an immediate family member in a client that they are auditing, and this immediate family member is a director or some employee who has significant influence over the engagement, then the auditor's independence is threatened. The auditor's independence is threatened, and therefore, this can be avoided by removing this individual from the engagement. Very, very important. Then let's talk more about employment with assurance clients. So what happens if the auditor, what happens if you have employment with an assurance client? What happens if you have employment with an assurance client? So let's read what I have here. The assurance team's independence might be threatened if a director or other senior employee at the client has recently been employed by the assurance firm. So for instance, right, if a director or some senior employee at the client has been employed by the assurance firm, just think about it. If they are going back to audit their former firm, just think about how it will be, right? So in this case, there might be self-interest, there might be familiarity threats because of the close connections, the close connections that remain between the individual and the assurance firm. So in such cases, it might be good to get an independent third party to review the audits. Very, very important. Very, very important. Here, you are always on the lookout for associations, long associations, and whether the auditor will have any interest. If he has any interest, then, it's a threat, and that threat must be safeguarded. So if employment with assurance clients also might create some self-interest and familiarity threats, and that must be watched. Then let's talk about recent service with assurance clients. So if an employee of the assurance clients transfers to the assurance firm, if the employee of the assurance client transfers to the assurance firm, then also self-interest threats, self-review threats, and familiarity threats may arise. So how? how, So for example, this employee, right? He moves employee of a client, let's say company A. He moves to, an audit firm called company B, He faces familiarity threats, once they are working together, once these two companies are working together in a client-auditor relationship, it's possible that you might have met the auditors, had familiarity with, these auditors, had a good association with these auditors, and that would affect the auditor's independence. So if an employee of the assurance client transfers to the assurance firm, there's a self-review threat there, there's a familiarity threat, and there's a self-interest threat. Very, very important. Very, very important. Very, very important. So you need to be on the lookout for that. You need to be on the lookout for that. Once an employee comes to join an audit firm, it's possible that, there'll be familiarity. Once an employee of a client you are auditing comes to join an audit firm, it's possible that there'll be familiarity, obviously. Yeah. Then you have long association of senior personnel with assurance clients. Long association of senior personnel with assurance clients. So there are times when senior personnel, would be on an assurance client for a very long time, So this obviously creates a familiarity threat, where the senior personnel becomes very familiar with the client. So how do you safeguard this? You safeguard this by rotations. That's why you rotate senior staff. You rotate them across different clients. Or you can even arrange for an additional professional accountant to review the work done by the senior employee to ensure that, there's no, undue influence there. You can also carry out quality control reviews. Please take note of this. In the audit of public interest entities, the code states that a key audit partner should be rotated after no more than 7 years. So keep that number in mind, 7 years. 7 years for a key audit partner, because it helps to, limit that long association threat that we've been talking about. Then let's talk about serving as an officer or director of an assurance client. Assurance providers should not serve as an officer or director of assurance clients. They shouldn't. However, if they provide basic administrative services like the one a secretary will provide, that should be okay. It is important that the auditor is not involved in making management decisions. It's very, very key. The auditor should not be involved in making management decisions. So basically, this is where we'll end this class for today. I'll post a subsequent video, which will be a part 2 to this, where we'll delve more into the guidance on the threats that accountants face, and we'll be trying to understand the different situations and how to safeguard the auditor or the accountant. So if you haven't subscribed to this channel, please do so. Hit the like button, hit the notification bell, so that anytime I post a video, you'll be notified to get it. Thank you and have a good day.